Welcome back to Crown's Crypto Cave and another skill video today as we get into a very historically relevant indicator, perhaps one of the most touted perhaps, and that is the moving average convergence divergence indicator. We're also going to be looking at a reverse function of it called the reverse MACD, and it's actually going to be created by one of our lovely community members. You know him as Caretaker. He is our trusty Irishman of high coding skills. I'm actually going to have a link in the description of this video to his reverse MACD indicator. You're free to use it. It's 100% free and open. He didn't create the idea, of course. It's coming from, way long ago, Johnny Doe, but he's put it into code, and that is really, really useful. And if you're a coder yourself, you might be able to make use of the open source for that. So with that said, I do want to start off by saying that this is one of those indicators that a lot of people typically learn first because it's one of those easier ones to kind of understand right at the outset. I myself actually did not learn this one first. I learned moving averages first, but it was, it was at the top of the list, and it's one of those ones that, has been relevant for, I don't know, the past few decades, realistically. So with that said, first off, what is it? The moving average convergence divergence indicator is a trend following momentum indicator that shows a relationship between two moving averages of a underlying price. The MACD is calculated by subtracting the 26-period exponential moving average from the 12-period EMA, and the result is a calculation of the MACD line. A 9-day exponential moving average is, of the MACD, called the signal line, is then plotted on top of the MACD line, and that is going to function for signals. So that is a long way of saying cross to the upside, good, cross to the downside, bad, or bullish and bearish essentially. But that's, as we're going to go over here, a very terrible way to use this. In fact, I want to say at the outset, if your idea of using the MACD is cross up, bullish, cross down, bearish, terrible. Of course, if that actually worked and was consistent over time, then everyone would do it and we'd all be rich, and that's just not the case. So with that said, there's gonna be a lot of ways to tweak this, and I do believe that the MACD is actually quite useful. It's just, it gets kind of a bad rap, and I've definitely given a bad rap in the past as well. Not because it's a bad indicator, but because people use it improperly, is what it comes down to. So with that said, let's first talk about where to actually get this one. I think the base one is pretty damn simple to get. Just type in MACD, all good right there. It's the built-in one, there you go. And then of course the reverse one, just type in, can you guess what it's going to be called? Reverse, and then probably just MACD like that. And there we go. That one by Caretaker. Like I said, I'll have a link in the description of this video as well, but that's one that I'm going to be referencing within this video. So let's get into it. And first things first, let's talk about the three moving parts in the actual MACD indicator down here. Or actually, let's go into the settings first and make sure that we're all on default. I want to make sure that I didn't change anything. Yep. Okay, so we got the 12, we got the 26, that's your fast, that's your slow, and then we got the signal smooth in at 9. Beautiful. Okay, great. And so what does that mean? That means that this is your fast, this is your slow, this is your signal, this is essentially your signal line, this is your MACD line, and then this is your baseline down here at the 0 read. So we'll just call that home base, okay? It doesn't need like an actual technical name. Just understand that the 0 read right here is relevant, very relevant in fact, as well as a histogram as well, which is just a visual representation of the differential between the MACD line and the signal line. So again, nothing too crazy right there. It's just a graphical representation of that, nothing more, nothing less. Okay, all right. As we spoke about, the simplest of simple ways to use this is just cross the upside right here. Good, bullish. Cross the downside right here. Bad, bearish. Is that the actual best way to be using this? Well, you can actually get away with it in a lot of ways, which I probably shouldn't say because it's gonna maybe reinforce some bad habits. But that is the traditional way, or perhaps we'll say the uneducated way of using it, or at least maybe a better way of putting it is it's suboptimal. Yeah, okay, there we go. That's a very diplomatic way of putting it. No, it's fucking stupid. Anyways, if that actually worked, like I said, everyone would just have a bot like that, and everyone would be rich. But that's just not the case. So what can we do here, or what is the main way that we can make this more efficacious? Well, first and foremost, if you are going to use it in this most basic of ways, that means if you are just looking for cross to the upside or cross to the downside, what's one simple little thing that can make it just significantly more effective? Well, it would be quite literally only paying attention to the same signals that are on the same side of the trend for that time frame. So for example, we're on a daily right now, 24-hour, at least I believe that's a daily. Wish I had more hours in the day. But if we define our trend, which let's just pick out this whole segment right here, we can very easily see that this is an uptrend. We're making higher highs and higher lows, lovely, all the way through basically the last, oh Jesus Christ, but the last 6 months or so. So what does that mean? If we just simply ignore all of the bearish signals from this and only take the bullish signals, we're going to increase our hit rate quite significantly. And just visualizing this right here, let's see. Okay, so let's say we take this sell signal right here. But of course, it's an uptrend. So if we were to just kind of back test this out, would this have been a good signal, one that you could have made money off of? To be fair, if you would have waited about 2 months, yeah, you could have gotten out at a little bit of a profit. But is that what we're looking for? No, especially with with what is a momentum type or momentum-based indicator. We want to actually be getting the momentum. There is an opportunity cost of being involved in a trade, and sitting in a trade like this for quite literally all the way from middle of May to potentially June is not a good use of trading equity, at least in my experience, and perhaps you might agree out there as well. Although, of course, everyone's got different opinions, but I would say that that's maybe not the best way. Now let's compare that with only looking at the bullish signals here. Of which, do we have a good one right here? Let's say that we look at this one right here on the 6th of July, and let's say that we take that. Well, what happens after that? Yeah, about sideways for the next couple weeks. And actually, let's get rid of this for now. And then what happens after that? Yeah, you do get the move. Quite nice. And then you actually do get a bearish cross right here. But again, let's just say that because of the context of the current trend is currently to the upside, we don't actually take it. And, do you miss a bit of an opportunity right here? Yes. However, I would argue that this is an opportunity that you'd want to miss, because if you're only focusing on the bullish signals, well, it's not too much long later where you actually do get your next signal right here. And about a few weeks after that, well, once again, a massive melt to the upside. Now, of course, this is a bit of a unique market that we're looking at right now, mostly going straight to the upside. But that's all world markets right now. So let's actually go back to 2018 and look at a little bit more of a dynamic cycle here, and just kind of reroute that. Same logic, but looking for the bear signals, because this is obviously a downtrend starting in officially. Where do we officially start this downtrend? Okay, well, here's your high right here, here's your low right here, here's your lower high right here. So downtrend is the potential, and then on the lower break right here, now we're officially in a downtrend. So now we only pay attention to the bearish signals. And as you can see right here, we actually do have a pretty damn good bullish signal, to be fair, out of this region right here. But I'm actually going to address this a little bit later in a way that you can also take advantage of those. And what happens soon after that, we do get a bearish signal right on this bar right here on March 7th of 2018. And Bitcoin then crashes down from about 10,500 at the start of that day over the next about month or so down to about 6,600. Quite nice. Okay, not bad. And then what do you know? You do get another bullish cross to the upside right here. Just ignore that one. And of course, this one was a terrible signal. It would have likely gone against you almost immediately. Likewise over here, this one, a decent signal as well. And you could very easily make the argument that was a good signal to take. And I would actually agree with you too, because we can match this up with other indicators, which we'll talk about later. But again, that's outside of the current context of this conversation. Then we get our next bearish signal right here in the context of a long-term downtrend. And that takes you all the way from, again, just blindly trading this, from about 9,300 to the low of about 6,000. $3,000 move, we'll call it. Quite nice. So you get the idea. Just simply only taking signals on the same side of the trend for that defined time frame is going to make it infinitely more successful. But there's a lot more that we can do, and I would even consider that still a very rudimentary and not optimal, suboptimal, that's the word that we're going to use, way to be using this. So let's bring that on to the next one. What's another tool that we can use within this that is going to help us define plays here? Well, the MACD histogram, and we can actually define divergence plays from this in the same way that you look for divergence on like an RSI oscillator or a stochastic oscillator, or basically any momentum oscillator that exists in the world, because they all have some variation of that component. So in this case right here, when you're looking for divergence plays, you're actually looking at the MACD histogram. I'm talking about this guy right here. Might be different colors for you. Again, just change them in this tab right here. It's very simple. Not going to change anything, as long as the inputs are as they are, you're going to get the exact same reads. Anyways, my point is that you can use this. You can use this in the same way that you look for divergence on other indicators. And let's just go over some basic theory right here. What is divergence? Well, divergence is when you have a momentum oscillator that is trading essentially obtuse to price action. What does that mean? That means that if price action is making consecutive higher highs, 2 or more higher highs, we'll call it, while the momentum oscillator is making lower highs, what is that telling us? It's telling us that price action is traveling higher, but momentum is waning over time. So what can we expect after that? Well, we can expect that there's likely going to be a pullback as the momentum wanes over time and people start taking profits. And, there's a bit of a positive feedback loop in there as well. And, that's always going to be a component of technical analysis to begin with. But at the end of the day, typically does net a nice pullback. So we can use that perhaps as exit signals. We could perhaps use that as also entry signals as well. However, I do find in a lot of ways that it works a little bit better for exit signals if you are using the MACD in the more rudimentary way that we described earlier. So let's just go over an example right here. Let's say that we identify this trend as an uptrend, so we're only interested in taking the long signals. Let's say we identify this long signal right here on the 14th of September, and that gets us in at this price point at about 10,250. And then we are looking for divergence to get out of this, or maybe let some of our position go. Again, just blindly entering in at the most just generic area possible, right on that closure. And what happens after that? Well, do we have any divergence plays? Well, we start to print a slightly lower highs on MACD starting in late October and early November. And what is price action doing during that time? Well, we have a high right here, which I will mark off with this. There we go. Hey, wait. Yeah, there we go. That's what I'm looking for. And then we have our next high right here. And what happens right there? Well, we have lower highs on MACD, we have higher highs on price action, and soon enough, what does Bitcoin do? Nice dump down for, by the way, this is on, it's actually not on log scale, but let's just put this into perspective. That's a 10% move right there, so fair enough. By the same token, we can use this, to the downside as well. So let's go back to 2018 and see what our last downtrend did. And where can we get a good one? Oh, here we go. We got a perfect one. So let's reference that same signal that we spoke about earlier with the bearish cross right here. That happened at about 10,500. That price action eventually goes all the way down. And what do we notice? Well, we have a low right here. We have a lower low right here. And what happens during these lower lows? Well, MACD histogram is printing low right here, higher low right here. So again, lower lows on price action, higher lows on oscillator, momentum is waning, and what do you know? We do actually put in a legitimate reversal right there for the short, for the shorter medium term. So we could use that as a signal to exit the position, or at least let a little bit go. Obviously, this can be combined with other tools as well. And maybe I'll show that a little bit later, but just in a very generic way, we can postulate it like that as well. So what I'm do is get rid of everything there. Actually, let's just hit the garbage can symbol, and all good. Okay, all right. And let me just get rid of these notifications over here. Okay, on to the next one. So, okay, all right. What's the next point of reference that we can just make the basic MACD indicator a little bit more efficacious? Well, when we are taking reverse signals, what we can do is if we notice that the MACD lines are actually getting to major extremes, and I'm talking about this guy right here, then those crosses at those extremes are usually pretty damn good ones. Those typically are like actual market reversals, maybe even macro reversals. Let's just kind of go over it really quickly here. This you might define as an extreme down over here. What do you know? Actually happens on the tick to about 20,000 bucks Bitcoin in late 2017 on December 19th. And as you do see, about 1 day later, we actually do officially get the cross to the downside. So in a signature like this, when it's at complete extremes, when I say extremes, I mean, do you see anything else that's anywhere near like this? No, you don't. Then those are typically going to be easily taken blind signals. Of course, this is not financial advice, I'm not a financial advisor, but in this case right here, I think that this one speaks for itself, as Bitcoin does in this case. Play at about a 40% move to the downside over the next 1, 2, 3, 4 days. Not bad. And then if we were to extend that over the next month or so, we could look at that as a It's almost 69% move right there. Not bad and a great number as well. And same thing on the other side right here. We once again see an extreme on the downside. Things get really, 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 really overdone. Or I shouldn't say overdone because there's no real such thing as that, but we could say extremes, yes. And what do you know? We get the bullish cross right here. That is pretty much on the low, actually. Let's actually highlight this bar. Nope, it's a little bit after the low. It happens right in this little short-term consolidation right here. But again, for reference, this happens at a price point of about 8,000 bucks, and then a rally emerges all the way to nearly 12,000 bucks. So that's a almost 43% rally right there. So again, those signals, they do typically play out pretty damn well. And what do you know? You know, we're in kind of crazy territory right here too, as Bitcoin actually does get the bearish cross as it is right now. But as you've seen in the past, things certainly have been crazier too. So this is not like, you know, parabolic blow off top extreme crazy. That's what we've seen back on over here. And same thing to the doom side down around here. We see that on that first major meltdown at 6,000, and then a little bit later on the coronavirus dump over here as well. But my point is that, you know, when you notice it at extremes, yes, you can't kind of blindly take those signals sometimes, and it'll be more or less okay. However, what would be the right way to be trading that? Well, of course, what makes a good trading plan? You have to have both your entry, your exit, and risk management. So how would you manage risk on something like this? Well, if you are looking at this as an actionable signal at a high level, what are you going to be doing? Well, what you should be doing is you should be marking off the last local high and using that as the point of risk management. And there you go. We can do the same thing back on over here too. You get the bearish cross right here. You see, it happens on, yeah, again, about 19th of December. So your last local high was right here. Boom, that's your stop loss. Yes, you know, quite a fair bit of risk because we're just dealing with massive numbers here, but you know, adjust for your asset, obviously. And everything that we're talking about right now is not like exclusive to Bitcoin or anything like that. I want to be very clear about that. This indicator works more or less the same in all markets. You can use it on all different time frames as well. I'm just choosing to use it daily and use Bitcoin because it's right here in front of my face, and I think it's just relatively easy to kind of grasp. Okay, so back into, let's actually get rid of the let's get rid of our boys right there. We can do the same thing to the downside right here. We get the bullish cross right here. We're at extremes, of course. This is coronavirus dump time. So if I do want to kind of punt along, if you will, which I don't know how I feel about that terminology, but I'd say, okay, we just had a local low right here. I'll put a stop right there. Boom, good. And I'm looking for closures. And what do you know? You know, things do, well, I mean, things, I mean, technically that is the low so far. So fair enough. Okay, on to the next one. What do we want to talk about now? Okay, now it's time to get onto the reverse MACD. All right, sweet one. So I'm gonna put it back on over here. Again, looking at inputs, I'm just running with default. This is what it likely will come with, 12, 26, and 9 right there. For my style, I've actually gotten rid of the MACD and signal line because I think that it just kind of muddies up my chart, and I'm not really interested in looking at it right now. I want to be cognizant of the 0 line actually, because I'm going to show you a strategy right here, which I actually do think is, I actually think that is straight up better than the MACD just in general, which is kind of funny. It's like, why create this indicator? So that we can reverse it and then use the reverse and fuck the regular indicator, kind of, in a way. All right, so let me get down and dirty into this one. Okay. So what is this 0 read showing right here? It's essentially showing when it interacts with the current price action, that is when the histogram is going to be quite literally 0. So this, so for example, price action right here, in order to get a 0 read on the histogram or just the home base, whatever you want to call it right here, we need to see price action come all the way down to where this baseline is. So it'd have to come down to about 73.50-ish region, and then it would have been a 0 read right there. Now, why is this important? Because we can base strategy off of this. And again, I'm gonna actually just kind of spoon feed a bit of a strategy right here. You're free to use this one. You're also free to not use this one if you don't want to. But we'll go over it right now because I do think that it is rather interesting here. So first and foremost, actually. Okay, yeah, a little bit dry first and foremost. Okay, here's what I'm gonna do. Here's the general strategy. We're gonna get rid of everything else, and what I'm gonna postulate here is that anytime price action crosses the 0 read, anytime that price action crosses the 0 read, that is essentially an indication that you could have a momentous play on the other side. For example, if we see the 0 read line crossing to the upside of price action right here, we could postulate a bit of a short position. And what do you know? Price action does collapse from about 86.50 down to about 67.50 right here. Not bad, not bad of a trade at all. Is it perfect? No. I mean, if you're looking at it like this would be your entry right here for a long position. And technically speaking, you do get a chance to get out at a at a decent level right here. I mean, this is after all about $1,000 move to be fair. But if you notice, what do you notice about this? The trend is to the downside. So do we really want to be taking long signals? Fuck no. Fuck no is the technical answer for that. Anyways, so again, identifying the trend is incredibly important, because if you can just take the signals that are on the same side as the overall trend, it's going to work out more often than not in your favor. Same thing right here. Trend switches up as we do see a higher low and then a higher high above this whole segment right here. Or sorry, here's your low, here's your high, here's your higher low, here's your higher high. Now we do get the bullish signal right here. And what do you know? Price action goes all the way from about 7,600 to 10,500. So not bad once again. So fair enough. And then what do we see on the other side? We see a high, a lower high, or sorry, we see a high, low, lower high, same low, lower high again. So 3 lower highs in a row, and then we break below the last 2 consecutive lows. So obviously it's continuation of trend after that time. And if you put in 3 lower highs at the same time, it's probably going to break to the downside. Not always, but probably. And what do you know? We see a nice short entry from about 8,900, which does kind of flip-flop around for the next week or so. And then coronavirus dump times all the way from about 9,000 to 4,900, we'll call it. So fair enough right there as well. Now, you're probably going to be looking at the regular MACD and say, crown, crown, crown. Like just like that, by the way. But crown, the MACD actually told me to enter sooner, and the MACD would have gotten me a better entry. Yes, in some of these cases, yes, that is very much true. However, as you can see right here, for example, there are a couple of one-offs in this segment right here. Whereas if you look at the reverse MACD, is there any one-off in this area right here? No, there's not. It tells you to be long all the way from here. And I mean, if you're just using this as an exit as well, which I'd say is a very bad way to be using it, in fact, then, technically speaking, it keeps you in the trade. And if you were to like blindly trade it like this, so you would have entered 7,600, you would have left 8,900. So even blindly trading it, it's okay. Is it optimal? Fuck no, it's not. So how would we have decided that this, it's time to be considering to get out? Look at your MACD histogram. Boom. High, lower high, lower high, high, higher high, higher high. We have divergence. That'd be a damn good signal to get out. We could also use this with an RSI as well. And in fact, I personally just identify RSI divergence a little bit easier. So for me, I prefer to match it up with something like that. Use your momentum oscillator of choice for divergence, and it will likely work pretty damn well with this. And what do you know? Do we have the same sort of read here? We have, actually, no, we don't. Actually, no, we don't at all, which is actually, no, we do. Okay, we do a little bit. High, very, 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 very slight. In fact, I wouldn't have even really identified this as divergence here. So that actually is a good point. We could also be basing that off of horizontals as well. Obviously, we did have that same level coming in from way the fuck back on over here. Test it over here. Yeah, get the hell out, obviously. But in this case, actually, MACD histogram divergence does get a little bit better. Same thing over here. The MACD tells you to enter short right here. Technically, and actually this one is a generally better position well, I mean, you do have a little bit of drawdown at the beginning, but it does fall through in your direction. Here's what I would postulate though. Yes, this is technically a better entry right here, and yes, you would have made more money, all other things being equal, if you would have entered here as compared to here. But what is something else that we should consider as traders? Opportunity cost, because there is an opportunity cost of being in a trade. It means that you're going to commit some of your trading equity to potentially have a reward versus your risk. And if that asset is not moving in your direction and you are in a market of infinite possibilities, which we certainly are, we don't just have to trade Bitcoin, obviously, trade fucking anything, then that money is dead money. And I would even say that at a high level, that should be considered a bad trade. in a lot of ways. And when you, and perhaps you're at this point right now, or perhaps you're getting to this point, but at some point you will start thinking like that because, well, you have to, you want to maximize, right? Of course you want to maximize. So with that said, I would argue that this right here is actually a better momentous entry. The reason why is because as soon as you do get the short, not only do you have trend on your side, things are moving, and they move rather aggressively after that. So fair enough. We do see a little bit of a flip-flop right around here as well, but this is why looking at trend is so important. And we do have low, high, higher, low, higher, high. So yes, we do look for longs in this region. And what do you know? We can enter right here. And it actually does, well, let's kind of zero in on this. All right, let's just go right here. Oh no, it would have actually gotten me out of that trade, to be fair. Technically speaking, you know, if you want to do the super conservative way of looking at this, open and close above or below the signal is going, or sorry, below the baseline is going to be an actual, you know, an actual entry. In this case right here, we do see a little bit of a one-off. Obviously, not every indicator is perfect, or sorry, not any real indicator is perfect that I'm aware of, but it does give you, you know, still does give you a pretty damn good idea. And to be fair, it, you know, if you would have got out right here and then you take the long signal again, realizing that that was just another higher low, well, you do get quite a nice trade from about 6,700 to about 10,000. And do we have some sort of divergences here too? Well, here's a high, here's a higher high, here's a higher high, here's a high, here's a lower high, here's a lower high. 3 drives of bearish divergence, 3 drives of higher high. Get the fuck out of that position. I would even say at the second drive of bearish divergence, consider letting some go, because you don't always get 3 chances, and 3 strikes, sometimes you're out. 2 strikes, sometimes go fuck yourself, right? so again, you know, just adding these very simple tricks right here can really make this a lot more efficacious. All right, I want to make sure that I'm getting everything here too. Okay, yes. Yeah, so this is the next point that I want to come up with. If you're using just straight up the reverse MACD to trade, how else could you kind of be postulating these trade ideas? Well, of course, we have our entry based off this, but our entry and our risk management is actually kind of defined by the same signal in a sense. What do I mean by that? Well, obviously, if you're using this to enter in on, then you have a very deliberate and obvious way to be managing risk as well. Meaning this, wherever this white line is, that is your risk for the trade if you are using that as your risk parameters. Now, could you use the way that I postulated earlier as well? Yeah, fuck yeah, you can do that. You know, is it going to be as, it's going to be a little more aggressive actually. Like let's say we take this entry right here and we just mark off the last local low, which would actually be, technically it's right around here to be fair. You know, actually in this case, it would have had a little bit more risk, but actually, to be fair, yeah, this case actually would have a little bit more risk if I'm just using horizontals, because it does start to ride this a little bit and then actually takes off. So fair enough. It's not till over here where the risk of using the white signal line as a risk management tool is going to be more costly than just using the horizontal. So you could use it in that fashion as well. Kind of making it more optimal over time. Then again, I would argue that, you know, once this one starts to take off, hey, take some fucking profits. You don't need to get super greedy. And of course, you know, if you've done it once, you can do it again. Do we want to do this another way as well? Again, we want to ignore signals that are on the wrong side of the trend, or on the other side of the trend, that is. So what does that mean? That means that in this case right here, when we're looking at an uptrend, this signal right here, fuck that one. Don't want anything to do with it. You know, even though technically speaking, it probably did look pretty damn good at the time, but are we making, you know, are we breaking the structure of about 9,100? No, we're not. So fair enough. Anyways, in this one right here, let's just do another example. Gives you another long signal right here in the context of a general uptrend. Beautiful. And what can we do right there? Well, if we are using the white line to manage our risk on, then we know exactly where our risk is for the next few days. I'd say, you know, 1, 2, 3. You can just kind of postulate it right there. I would even just use a horizontal here too. Just mark off the last higher low right in this territory right here. And when they start to cross, I'd switch over to the horizontal here too. And then, what do you know? We get some divergence on the other side, a few $1,000 higher to be fair, so not bad. And of course, this is a daily, you know, it does take some time to play out. Patience is required. You can use this on lower term timeframes as well. General rule is higher term timeframes, signals are going to be more efficacious in general. Lower term timeframes are going to have more noise in them a lot of the time. Not always, but you know, I would say that it's a general rule. Okay, what else do we want to do with this? Is that it? Is that it? Yes, we can use it to manage our risk. We can use it for entry. We can use it for a general identification of kind of where we're at as well. And because this is in some ways representative of the histogram as well, we actually can even make trend lines off this, which I do think are, this is not optimal to be honest, but I do think that within a video like this, I might as well be as thorough as possible. And what we can do is when we notice that an area is getting a lot of love, essentially, like you see this area right here, you know, 2 spikes right here and basically bottoms out. And we see this spike right here, you know, same thing right there. But we can just put a horizontal right there and we notice that, oh, it seems to be in the same area. And likewise to the downside over here too. It's not perfect, but it is a regression. We do see a lot of activity within this level, grabbing this territory right here, this one right here, this one right here. And we can also define that whenever we move outside of this general range, it's just more and more extremes. I mean, this is your coronavirus dump extreme. This is your parabolic rally in 2019 extreme. This is your 20,000 parabolic rally extreme right here. And then same thing over here. In fact, actually, we're not even at that big of extremes, but we are hitting the same trend line, which essentially gets it within the context of the current price action. So with that in mind, it kind of lets us know when things are, you know, a little more crazy, so to speak. Again, more of like a cool way to use this, not necessarily like the most significant way to be using this, but it does give you a better idea of what's going on. Okay, is that everything that I wanted to do? I think that is everything that I wanted to do. This video is already 31 minutes long as well. So with that said, I think I'll leave it off right there. I hope this one serves you well. The MACD is actually a very powerful indicator. It's just a lot of people use it improperly. Actually, there's one last thing. I saved the best one for last, actually. Saved the best one for last on this one. Okay, let's get rid of everything right here. Let's get rid of everything. All right, and I'm going to go back into it. Yeah, I'm going to go back into it like this. Okay, so we're going to get rid of the reverse MACD as it is right now. And what we're going to do is we're going to go back in the most basic of basic ways to use this one. And this is actually perhaps, at least in my opinion, this is the most powerful way to be using this actually. So for all the TA nerds who stay into the very end, this one's for you essentially. And it's this. Okay, all right. It is a this. Okay, so when we bring this up, and when we are defining, let's actually get this on the same side as well. Okay, there we go. That makes a lot more sense. Ah, beautiful. All right, lovely. Lovely, lovely, lovely. Okay, let's just make the assumption that you know how to use horizontals. You know how to plot them off in the most basic of basic senses without going into a deep dive on this one, which we certainly don't need to right now. Just marking off higher highs and higher lows within a range is going to be good enough. We can do it on this segment right here. We have a clear trading range, right, between about 10,000 on the highs and about just below 9,000 on the lows. Now, the best way to use the MACD is when you see a break of a range like this, and then MACD is on the same side of that break. That's a good break. How do we know? Well, you see it right here. You actually do see the bullish cross right here, yes, but we don't actually break the topside resistance until a little bit later right here. And at that point, yes, momentum is still actually increasing to the upside. The breakout is real. That's one of the ways that we can figure out if a breakout is real or not. So I do think that is relatively important to kind of understand. And that is actually one of the best ways, in my opinion, to be using the MACD. So keep that in mind. If you know how to plot your horizontals, look for your MACD or any momentum oscillator for that matter as extra confirmation that a level is actually broken. In this case right here, it's very obvious that it's going to break because momentum is increasing the upside and we're actually breaking above a structure as well. I'll leave you with that. I'd like to wish you the best ones again. Also, you can find the reverse MACD in the description of this video. I hope this one serves you well. I'll see you in the next one. Take care.